So, everybody, welcome. I'm sorry that was a little bit wonky, but I'm Joe Lucey. Most of you are aware of us here at Secure Retirement. Joining us here this morning, most of you are also aware of Tony Shink. Tony Shink is our is the institutional manager at Minneapolis Portfolio Management Group, one of the partners we've worked with for many years now with portfolio management. And Tony, I'm just going to let you kind of run with it from here, but let's talk a little bit about what some updates on the portfolio. Where are things at? What are you guys looking at going forward?
Hey, no, sounds great. I really appreciate the opportunity and I always enjoy the time that we spend together. And I hope everyone is able to enjoy the last few weeks here of summer. And I really, again, appreciate everyone for investing a few moments of their day for this brief discussion. Like Joe said, I thought today would make sense just to give kind of a brief update of what's going on in the markets over the last several months, and then kind of pivot a little bit, focusing on our portfolio and how we've been investing through the ups and downs, if you will, over the last couple of months, and where we are positioning the portfolio going forward. And as always, we can entertain questions throughout this call as people either just click on the chat to add a comment or a question, and Joe will let me know what's on everybody's minds. But as many of us are aware, as we enter 2021, it was a very strong beginning to this year. Then as we started to rotate from winter to spring and spring to summer, the markets began to change course a little bit. A lot of the popular outlets that people are reading, regular TV, cable news outlets, and other media sources, be it periodicals or newspapers, really started to cling on to the idea of the Delta variant and COVID breakthrough infections is causing a lot of the headaches that caused some of the wobbling in the market over the last couple of months. It's an easy story. It makes a lot of sense. And personally, I think that between the COVID variants going on and some of the other macro events, such as hurricane activity, such as yesterday, Henri, before that on the East Coast, Afghanistan, these are all horrible events that we're going through. However, these are just temporary blips, if you will, in the news cycle that really, in my opinion, don't affect the market considerably over medium and longer terms. So I think these one or two news feeds that we're hearing about constantly day in and day out might be a little simplistic for the complex investment system that we all are putting our money into. Now, if we take a look at the S&P 500, specifically its price to earnings ratio, or PE, that you might be familiar with, is really a quick number to give us a check-in to see how expensive a stock or the general market is, priced either on a trailing basis looking back over the last 12 or so months, and also you can look at it of what is expected going forward for the next year or so. And if you look at the PE, basically, in our opinion, the market may have gotten a little ahead of itself. Historically, the market's PE is somewhere around 17 to 20. And at the end of July, the trailing PE was almost 31. Now, that number is not very strong, in my opinion, to give us a feeling just because of what we've all experienced over the last year. But if we look going forward, the expected future PE is at about 22. It's at 21.73 according to the S&P Global, which again is getting a little pricier. So it's likely the market's gotten a little frothy going forward. So basically, we moved from spring into summer and the markets began to get a little pricey. Individual company stock valuations, if you were, got a little stretched. And many traders typically take the summer off or take longer than normal vacations during summer. And it's likely that many of them took short-term profits and took their money out, off the table, if you will, during the summer. And as they did that, because they were concerned the market was a little expensive, we had less people trading than typical, as you would expect during fall and winter and springtime. So we are basically in the summer doldrums with less people trading in a market that's valuations are a little stretched. What that may have given alternative traders, algos, or computers more influence over the general market on a temporary basis as they tried to move the market to capture short-term pennies, if you will. And their pull moved the market up and down, potentially causing greater swings than we normally would have over the other months of the year. But as I look at the fundamentals of the underlying cornerstones of investing, what are the strengths of the companies that we're looking at? What are the true things that really drive the stock price of companies that we're investing in? That is earnings. And when we look at the solid shape that our economy is in, the solid performance that many of these businesses are showing, we're likely in a good position. The only things that are concerning us right now, but I don't think are going to really have a big impact on us, one is the COVID variants. Are they having significant breakthroughs of these infections that are causing serious illnesses that are requiring hospitalizations and the potential for rolling shutdowns? We don't see that happening. We don't think that we're going to really see that, but that is in the back of our minds. Another thing that we're always watching for is unexpected declines in corporate earnings. Are we looking at companies that are starting to see slowdowns? At this point, we're not. Companies are still doing quite well. We're still seeing very robust earnings. Yes, we aren't seeing the same growth that we saw at the end of last year and the beginning of this year, but that doesn't mean things aren't still moving forward and going well. We're just at a more realistic pace than we were as we were coming out of the coronavirus pandemic last year. Business leaders continue to have positive commentaries, and we're looking to see if there's any slowdown or negativeness that are starting to pop up in those discussions, and at this point, we don't see them. So the only other thing that we're looking for is the Fed. Is the Fed misreading the data that they're getting, which might cause some more wobbles in the market? Would they more aggressively or more sooner, if you will, start tapering and raising interest rates? And that could cause some slight problems in the markets temporarily. Again, at this point, we don't see that happening. It appears that the market and individual companies are in good shape. The U.S. really seems to be in a reflationary period. In other words, what we're seeing is that price increases in businesses, our economy is striving towards achieving full employment and continued growth. We still have plenty of job openings out there. Things are still improving. We are not concerned today where things are at. We just feel that it's just summer doldrums, and we should be improving going forward. Now, as I look forward, though, as I say that, as things are going really well, one thing that does bother me personally is the popularity contest of the largest and most well-known companies and their rising valuation. And I'm talking about the Apples, the Facebooks, Teslas, these cocktail hour stocks that you've heard me talk about before. These are really good companies with good products and services. However, many of the uninformed may be continuously putting money into these large businesses, these well-known companies, because they feel like these are safe places to be. Yet, many of these businesses are stretched from a valuation standpoint. And my concern is, as we go forward, the likelihood of inflation and rising interest rates may put a damper on corporate returns, which could really impact these cocktail hour stocks. As an example, Microsoft right now is trading at roughly 14 times sales. not earnings, but actual sales, which is concerning to us. When you take a look at one of our newer names, WestRock, which I'll hit upon a little later in this call, they're a corrugated box manufacturer. It's trading about half times sales and has 3 times the dividend yield. There are great companies out there with attractive valuations that aren't being influenced by the overall market, popularity contests that we think are some great areas to be moving into. Now, the companies that we think have historically performed well and have protected investors as you come out of a recession into a growing economy, it's an environment where cyclicals and traditional value type of businesses have performed, and we believe that's what we're in today. Now, to give you an idea of where we're investing, and we are moving our portfolio to, it's really in groups of holdings or major themes. And there's roughly 7 areas that we've been putting our clients' money to work in. We've been investing in infrastructure. It's been well over 50 years since our nation's roads and airports and bridges were designed and developed. Our population has almost doubled. And there seems to be, according to some experts, a $15 trillion gap between where we are today and where we should be when it comes to infrastructure. So we've been investing in companies like Caterpillar, large land moving equipment, Siemens, Terex that make aerial cranes, and Canadian Pacific, a railroad. We are hearing more and more about EV or hybrids. We think electric vehicles, even though it is a very, very small portion of our country's vehicle logistics programming that's going on. But electric vehicles, we think, have the opportunity for enormous growth. We're also seeing upwards of 20 countries have put restrictions on fossil fuels. So we think there is a push and will continue to be a need for investment in electric vehicles. We're looking at putting clients' money in businesses such as General Motors, Borg Warner, which is an engineering company specifically for engines and motorized vehicles, electric vehicles, and Orion Engineered Carbon, which you may have heard me talk about before. OEC is a company that manufactures carbon black that is needed to really strengthen tires and make tires last longer. In fact, when you look at electric vehicles now, they are heavier, and the torque on these are significantly greater than the combustible engines that most of us are driving today. However, between the weight and the torque, it causes a 30% greater wear and tear on tires, and we think OEC will benefit as we continue to see a rotation more towards electric vehicles going forward. Our company is also investing in 5G and cloud technologies. This is likely the backbone of the dominant tech development that we're seeing going forward. We're also seeing our country really looking to expand broadband across the country in areas that are really the last points, where it's very difficult to get those last 18 million individuals, if you will, from the farms and farther areas away from the city onto the need for broadband into their homes, into those buildings. So we're investing in companies like Cisco, the router company, IBM, Qualcomm that makes the chips for our cell phones, and Oracle, which is starting to move more and more towards cloud-based computing. Aerospace is another area that we've been investing in. As we look forward, passenger traffic could outpace global GDP growth by 50% a year through 2038. So we see huge opportunities for companies that have really been negatively impacted by the press over the last couple of years. Not to mention that the satellite deployment is likely to quintuple in this decade. So we think some of the winners in these areas could be Boeing, which has not had a great run over the last couple of years, but we really believe is turning around and has some very solid forward growth potential. And Crane Company, another business that people really don't hear a lot about. However, they make braking systems, as an example, for the airlines. The fifth area that we've been investing in is online retailing. It's estimated that we'll see online retailing grow by another 50% in just the next several years. By 2024 is what estimates are looking at for a 50% increase. And with online retailing continuing to grow, you need logistics. You need the ability to transport. And this is going to positively propel companies like FedEx and WestRock forward. FedEx is, as you know, one of our major delivery companies in the United States. And as I said earlier, WestRock, which is a corrugated box manufacturer, is making the boxes necessary to be able to deliver product to retail as well as individual homes. And another name that we've recently added to our portfolio is a small position. It's Curate, a company you may not be familiar with. However, they are the parent holder of many online names such as QVC. And as we continue to see $6 trillion pumped into this country to fight off the negative effects of the coronavirus, we have a debasement of our currency. And we believe that traditional assets, gold as an example, companies like Newmont Mining could benefit as we see our currency getting cheaper and cheaper. And real estate, we have added to our portfolio as a way to hedge against inflation. We're looking at hard assets, companies like Simon Properties Group that owns many Class A shopping malls in our country, as well as Madison Square Garden Entertainment, MSGE, which owns fabulous venues, of course, namesake Madison Square Garden, but they also own things such as Tao Hospitality and Radio City Rockettes. These are great reopening plays in areas, iconic locations that just can't be replicated. So we're trying to take advantage of these areas as we move forward. And as the market has given us a little pause, that gave us the opportunity to invest in some of these areas that we think our clients will benefit going forward. And again, the areas that we're looking at are infrastructure, electric vehicles, 5G, cloud technology, aerospace, online retailing, and hard assets. A lot of these things are outlined and go into a little more detail on our second quarter newsletter. So if you're interested in receiving that, please let Joe Lucey know. Are there any questions? Because I have just been rambling on and on here for the last 10 or so minutes with a lot of information. Joe, have you seen anything?
I have not seen any questions come across. We'll kind of keep it open here for just a second or two, and then, move on from that. Tony, one of the things we saw here early in the year as we were coming out of the, as things were opening up with COVID and what have you, is a real good shift towards value. Do you see that staying there, or do you think the pendulum's going to go back towards the more growth again? Or, what are your thoughts there?
Well, I'm a little biased on the
based on the fact
side.
that you tend to focus on value, but okay.
Just to throw that out there to begin with. However, when we see what's going on with inflation, you hear our Fed talking about transitory inflation, the fact that we had difficulty getting manufacturing going on earlier in the year, in the last year, that we were having difficulty getting product and inputs to be able to make the things that we need, that we weren't able to get airline pilots back into the air. All of these things were pent-up demand and transitory or temporary. As we have those things going forward and being worked out, we believe that that is going to slowly work itself back and be helpful for these traditional cyclical and value type of names. Like I also said, that we have that $6 trillion that's been pumped into our country over the last year, and all the other currency that's been floating around. Basically, you have a lot of paper chasing fewer goods, which is the traditional definition of inflation. And we truly believe that even though we had a little bit of a setback over the last couple of months, that we are in a historical position where you're going to see the cyclicals and value type of companies really perform going forward. It's unfortunate, though, that we had the variant or the Delta variant pop up, which made people a little concerned that are we going to have some rolling shutdowns? Are we going to have things happen that we experienced over the last year? And we just don't see that going forward. So we really believe that the value type of names, the cyclicals, the Caterpillars of the world, the Simon Properties are going to do well going forward. I hope that answered your question.
Excuse me. I think it did. So since we don't really have any questions here today, I took a bad time to grab a drink of water again.
Sorry about that, Joel.
Well, we'll go ahead and close it up this week. We'll be back next week. If for those of you that are with MPMG, you already know that MPMG has done a tremendous job outperforming the S&P 500 and most indices, broad-based indices over, trailing 10 and 15-year periods of time. I assume that you probably believe, Tony, that you can continue to do that, although future results, of course, are not guaranteed. But if you are not with Minneapolis Portfolio Management Group, I encourage you to reach out to us here at Secured Retirement, and let's discuss how they can be brought into a diversified portfolio and help you accomplish your retirement needs. So with that said, we'll go ahead and close up here. I am going to, here's our disclaimer and Tony's picture. Boy, we had more slides in here than I thought. But if you'd like to reach out to us, the easiest way to do that is to go to info@securedretirements.com or just reach out to us on the phone, 952-460-3260. With that said, we will go ahead and wrap up here for the day. We'll be back next Monday with another Market Huddle. And Tony, thanks again for sharing your insights here today with us.
Great. Well, thank you for the time, and stay healthy, everyone. We appreciate it.
Everybody have a good day. Bye-bye.